Hello, we are the Group 9. We are going to discuss about the stock and their valuation. Legal rights and privileges of common stockholder. A corporation common stockholder are the owner of the corporation and as such they have certain rights and privilege as discussed in this section. We have the keywords in which we will discuss the control of the firm. First keywords are the proxy, a document giving one person the authority to act for another, typically the power to vote share of common stocks. Proxy fight, and an attempt by a person or group to gain control of a firm by getting its stockholder to grant that person or group the authority to vote its shares to replace the current management, and take over, an action whereby a person or group succeeds in ousting a firm's management and taking control of a company. Control of the firm. A firm's common stockholder have the right to elect its director, who in turn elect the officer who manage the business. In a small firm, usually the major stockholder is also the president and chair of the board of directors. In large publicly owned firms, the managers typically have some stock, but their personal holdings are generally insufficient to give them voting control. Thus, the management of most publicly owned firms can be removed by the stockholders if the management team is not effective. State and federal laws stipulate how stockholder control is to be exercised. First, corporation must hold election of directors periodically, usually once a year, with the vote taken at the annual meeting. Each share of stock has one vote, thus the owner of 1,000 shares has 1,000 votes for each director. One stockholders can appear at the annual meeting and vote in person, but typically they transfer the right to vote to another person by means of a proxy. Management always solicits stockholders proxies and usually receive them. However, the earnings are poor and stockholder dissatisfied, an outside group may solicit the proxies in an effort to overthrow management and control of the business. This is known as a proxy fight.
I'm Peter John Prago and I'm about to discuss the preemptive right. Preemptive right, a provision in the corporate charter or bylaws that gives common stockholders the right to purchase on a pro rata basis new issues of common stock or convertible securities. Common stockholders often have the right called the preemptive right to purchase on a pro rata basis any additional shares sold by the firm. In some states, the preemptive right is automatically included in every corporate charter. In other states, it must be specifically inserted into the charter. The purpose of the preemptive right is twofold. First, it prevents the management of a corporation from using a large number of additional shares and purchasing those shares itself. Management could use this tactic to seize control of the corporation and frustrate the will of the current stockholders. The second, and far more important, Reason for the preemptive right is to protect stockholders from dilution of value. For example, suppose 1,000 shares of common stock, each with a price of $100, were outstanding, making the total market value of the firm $100,000. If an additional 1,000 shares were sold at a $50 a share, or for $50,000, this would raise the firm's total market value to $150. When the new total market value is divided by the 2,000 total shares now outstanding, a value of $75 a share is obtained. The old stockholders would thus lose $25 per share, and the new stockholders would have an instant profit of $25 per share. Thus, selling common stock at a price below the market value would dilute a firm's price and transfer wealth from its present stockholders to those who were allowed to purchase the new shares. The preemptive right prevents this. Stock price versus intrinsic value. We saw in Chapter 1 that a manager should seek to maximize the value of his or her firm's stock. In that chapter, we also emphasized the difference between stock price and intrinsic value. The stock price is simply the current market price, and it is in Chapter 8. We demonstrated the benefits of diversification. These benefits lead many experts to recommend that investors regularly hold some portion of their wealth in well-diversified index funds. These index funds have the benefit of providing diversification with low transaction cost. For example, a Vanguard fund that tracks the S&P 500 has total transactions that are less than 0.20% of the total amount invested. In effect, these funds are holding a portfolio of S&P 500 stocks where each stock's weight in the portfolio is determined by its current market capitalization, which is its stock price multiplied by the number of shares outstanding. So, for example, if a stock's market capitalization equals 1% of the total market capitalization of the S&P 500, then an S&P 500 index fund or exchange traded fund would have 1% invested in that stock. While generally applauded, some analysts have expressed concern that index funds may typically overinvest in overvalued stocks. Here's the idea. As stocks become overvalued, their market capitalization rises to levels above what should be given their intrinsic value. And this increase automatically results in an index fund holding a larger percentage of the overvalued stock. To address this concern, fund investments have arisen that use portfolio weights that are based on approaches than market capitalization. Oftentimes, these alternatives are characterized as beta or strategic beta funds. These funds typically use a variety of different approaches for weighting the index. For example, some use an equal weighted approach where each stock in the index has the same weight regardless of market capitalization. Others weight the stocks according to some fundamentals such as dividends or earnings that are believed to be correlated with intrinsic value. In a recent article on CNBC.com, a Morningstar analyst summarized these funds in the following way. What investors are getting here is an active bet, and no two products are the same even if they have the same strategy. said Morningstar analyst Alex Bryant. Fees are usually considerably lower than those associated with actively managed funds, but more than with traditional index funds. The article also points out that these funds have become quite popular in recent years. Using data from Morningstar, they report in 2015 that mutual funds and exchange traded funds in this category have grown more than 170% in the previous 5 years, and they now have total invested assets of more than $540 billion. As you might expect, not all analysts think that smart beta is a smart idea. Some point out that you are still paying higher fees to try to outguess the market. Some Something which has been notoriously hard to do for many funds. Perhaps not surprisingly, Jack Bogle, Vanguard's founder and a longtime champion of index funds, has characterized smart beta investing as stupid. Easily observed for publicly traded companies. By contrast, intrinsic value, which represents the true value of the company's stock, cannot be directly observed and must instead be estimated. As the figure suggests, equilibrium occurs when the stock's price equals its intrinsic value. If the stock market is reasonably efficient, gaps between the stock price and intrinsic value should not be very large, and they should not persist for very long. However, in some cases, an individual company's stock price may be much higher or lower than its intrinsic value. During several years, leading up to the credit crunch of 2007 to 2008, most of the large banks were reporting record profits and selling at record prices. However, much of those earnings were illusory because they did not reflect the huge risk that existed in the mortgage-backed securities that these firms were purchasing. So with hindsight, we know now that the market prices of most financial firms' stocks exceeded their intrinsic values just prior to 2007. Then when the market realized what was happening, those stock prices crashed. Citigroup, Merrill Lynch, and others lost more than 60% of their value in a few short months. And bears Stearns, at the time the fifth largest investment bank, saw its stock price drop from $171 in 2007 to $2 just because its ultimate collapse in mid-March 2008. It clearly pays to question market prices at times.
I'm Elvis Luceda and I'll be discussing why do investors and companies care about intrinsic value. The remainder of this chapter focuses primarily on different approaches for estimating a stock's intrinsic value. Before these approaches are described, it is worth asking why it is important for investors and companies to understand how to calculate intrinsic value. When investing in common stocks, one goal is to purchase stocks that are undervalued. Example, the price is below the stock's intrinsic value and avoid stocks that are overvalued. Consequent, Consequently, Wall Street's analysis, institutional investors who control mutual funds and pension funds, and many individual investors are interested in finding reliable models that help predict a stock intrinsic value. Investors obviously care about intrinsic value, but managers also need to understand how intrinsic value is estimated. First, managers need to know how alternative actions are likely to affect stock prices. The models of intrinsic value that we cover help demonstrate the connection between managerial decisions and firm value. Second, the manager should consider whether their stock is significantly undervalued or overvalued before making certain decisions. For example, firms should consider carefully the decision to issue new shares in if they believe their stock is undervalued. An estimate of their stock's intrinsic value is the key to such decisions. Two basic models are used to estimate intrinsic values: the discounted dividend model and the corporate valuation model. The dividend model focuses on dividends, while the corporate model goes beyond dividends and focuses on sales, cost, and free cash flows. In the following sections, we describe these approaches in more detail. Next topic is the discounted dividend model. The value of a share is of common stock depends on the cash flow it is expected to provide. And those flow consist of two elements: the dividends the investor receive each year while he or she holds the stock, and two is the price received from the stock is sold. The final price includes the original price paid plus an expected capital gain. Keep in mind that there are many different investors in the market and thus many different sets of expectations. Therefore, investors will have different opinions about a stock's true intrinsic value and thus its proper price. The analysis as performed by the marginal investor, who actions actually determine the equilibrium stock price, is critical, but every investor, marginal or not, implicitly goes through same type of analysis. Marginal investor, a representative investor whose actions reflect the belief of those people who are currently trading a stock. It is the marginal investors who determines a stock's price. Market price, the price at which a stock sells in the market. Growth rate, or G, the expected rate of growth in dividends per share. Required rate of returns, or RS, the minimum rate of return on the stock that a stockholder consider acceptable. Expected rate of return, or R is to S, the rate of return on a common stock that stockholders expect to receive in the future. Next is the actual or realized return, or R is the rate of return on common stock actually received by stockholders in some past periods. RS may be greater or less than R is to S and or RS. Dividend yield, the expected dividend divided by the current price of a share of stock. Capital gains yield, the capital gain during a given year divided by the beginning price. And the last is the expected total return, the sum of the expected dividend yield and the expected capital gains yield. The following terms are used in our analysis. First is the DT, the dividend a stockholder expects to receive in the year of each year. Next is the PO, is equal to actual market price and the stock today. Next is the P hat T, both expected price and the expected intrinsic value of the stock in the year of each year, T pronounced as P hat T. G, expected growth rate G in dividends as predicted by an investor. RS, required or minimum acceptable rate of return on the stock considering its riskiness and the return available on other investments. R hat S, expected rate of return, pronounced R as R hat S, that an investor believes the stock will provide in the future. Next is R bar S, actual or realized after the fact rate or return, pronounced R bar S. You can expect to obtain a return of RS 10% if you buy a stock today, but if the market declines, you may earn an actual realized return that is much lower, perhaps even negative. D1 over P0. Dividend yield expected during the coming year. If company XS stock is expected to pay a dividend of D1 $1 during the next 12 months, and if XS current price is 0 pesos or $20, the expected dividend yield will be $1 or $20, 0.5 or 5%. Different investor could have different expectations for the one, but again, the marginal investor is the key. Next is the P hat 1 minus P0 over P0. Expected capital gains yield on the stock during the coming year.
I'm Gaylor Dakino and I will be discussing expected dividends as the basis for stock values. In our discussion of bonds, we use equation 7.1 to find the value of bond. The equation is the present value of interest payments over the bond's life plus the present value of its maturity or par value. Stock prices are likewise determined as the present value of a stream of cash flows, and the basic stock valuation equation is similar to the ones for bonds. What are the cash flows that a corporation will provide to its stockholders? To answer that question, think of yourself as an investor who purchases the stock of a company that is expected to exist indefinitely. You intend to hold it forever. In this case, all you and your heirs will receive is a stream of dividends, and the value of the stock today can be calculated as the present value of an infinite stream of dividends. What about more typical case, where you expect to hold the stock for a finite period and then sell it with what will be the value of P hat 0 in this case? Unless the company is likely to be liquidated or sold and thus disappear, the value of the stock is again determined by equation 9.1. To see this, recognize that for any individual investor, the expected cash flows consist of expected dividends plus the expected sales price of the stock. However, the sales price to the current investor depends on the dividends some future investors expects, and the investor expected sale price is also dependent on some future dividends and so forth. Therefore, for all the present and future investors in total, expected cash flows must be based on expected future dividends. Put another way, unless a firm is liquidated or sold to another concern, the cash flows it provides to its stockholders will consist only a stream of dividends. Therefore, the value of share of stocks must be established as the present value of the stock's expected dividend stream. Constant growth stocks. Equation 9.1 is a generalized stock valuation model in the sense that the time pattern of DT can be anything. DT can be rising, falling, or fluctuating randomly, or it can be zero for several years. Equation 9.1 can be applied in any of these situations. And with a computer spreadsheet, we can easily use the equation to find stock's intrinsic value, provided we have an estimate of the future dividends. However, it is not easy to obtain accurate estimates of future dividends. Still, for many companies, it is reasonable to predict that dividends will grow at a constant rate. In this case, equation 9.1 may be rewritten as follows. Illustration of constant growth stock. Table 9.1 presents an analysis of Keller Medical Products stock as performed by a security analyst after a meeting for analysts and other investors presided over by Keller's CFO. The table looks complicated, but it is really quite straightforward. Part 1, in the upper left corner, uh, provides some basic data. The last dividends which was just paid was $1. The stock's last closing price was $20.80 and it is in equilibrium. Based on an analysis of Keller's history and likely future, the analyst forecast that earnings and dividends will grow at a constant rate of 4% per year. and that's and that the stock's price will grow at the same rate. Moreover, the analyst believes that the most appropriate required rate of return is 9%. Different analysts might use different inputs, but we assume for now that because of this analysis is widely followed, her results represents those of the marginal investors. Look at part 4, where we show that the predicted stream of dividends and stock prices along with annual values for the dividend yield, the capital gains yield, and the expected total return. Notice that the total return shows in column 6 is equal to the required rate of return shown in part 1. This indicates that the stock analyst thinks that the stock is fairly priced, hence it is in equilibrium. She forecasted data for 10 years, but she could have forecasted out to infinity. Part 2 shows the formula used to calculate the data in Part 4, and Part 3 gives example of the calculations. For example, D1, the first dividend a purchases would receive, is forecasted to be D1 $1, 104 or 1.4 and the note that in table 9.1, the forecasted intrinsic value is equal to the current stock price, and the expected total return is equal to the required rate of return. In this situation, the analyst would call the stock a hold and would recommend the investors not to buy or sell it. However, if the analysts were somewhat more optimistic and thought that the growth rate would be 5.0% rather than 4.0%, the forecasted intrinsic value would be by equation 9.2, which is 26 equals to $26.25, and the analyst would call it a buy. At G3.0, the intrinsic value would be $17.17 and the stock would be a sell. Changes in the required rate of return will produce similar changes in the forecasted intrinsic value and thus the equilibrium current price.
Dividends versus growth. The discounted dividend model, as expressed in equation 2, shows that other things held constant, a higher value for D1 increased the stock price. However, equations 9.2 shows that the higher growth rate also increased the stock's price, but now recognize the following. Dividends are paid out of earnings, therefore growth in dividends requires growth in earnings. This is the figure 9.2 that shows that dividends earnings growth in the long run, of course, primarily because firms retain earnings and reinvest them in a business. Therefore, the higher the percentage of the earning retains, the higher the growth rate. To illustrate this, suppose you inherit a business that the $1 million of asset and no debt. Thus $1 million of equity, the expected return of equity equals 10.0%. So its expected earnings for the coming year are 0.10. 0.10 times $1 million is equal to 100,000. You could take out the entire 100,000 of earnings and dividends, or you could reinvest some of all of the 100,000 in the business. If you pay out all the earnings, you will have $100,000 and of dividend income this year. But dividends will not grow because assets and therefore earnings not grow. However, suppose you decide to have a firm pay out 60% and retain 40%. Now now your dividend income in 1 year will be $60,000, but asset will rise by $40,000, and earnings and dividends will likewise increase. Next year's earnings equals prior earnings ROI retained earnings equals 100,000, 0.1, 40,000 equals 104,000. Next year dividends equals 0.6, 104, 104,000 and 62,400. Moreover, your dividend income will continue to grow by 4% per year. Therefore, growth rate equals 1, payout ratio, ROI equals close parenthesis 1 minus 0.6, I open parenthesis 1 equal minus 0.6, close parenthesis. Moreover, your dividend income will continue to grow by 4% per year. Thereafter, growth rate equals 1 payout ratio, ROI equals 1 minus 0.6 times 10.0% equals 0.4 times 10.0% equals 4.0%. This demonstrates that in the long run, growth and dividends depend primarily on the firm's payout ratio and its ROI. In our example, we assume that other things remain constant. This is often but not always. A logical assumption, for example, suppose the firm develops a successful new product, hires a better CEO, or makes some other change that increase the ROI. Any of these action could cause the ROI to increase, and this demonstrates that in the long run, growth in dividends depends primarily on the firm's payout ratio and its return on equity. In our example, we assume that other things remain constant. This is often, but not always, a logical assumption. For example, suppose the firm develops a successful new product, hire a better CEO, or make some other change that increase the return on equity. Any of these action could cause the return of equity to increase and thus the growth rate to increase. Also, not that the earnings of new firms are often low or even negative for several years and then begin to rise rapidly. Finally, growth levels of the firms approach maturity. Such a firm might pay no dividends for its first few years, then pay a low initial dividend but let it increase rapidly. And finally, make regular payments that grow at constant rate once earnings have stabilized. Earnings has stabilized. In any such situation, the non-constant model, as discussed in a later section, must be used. Which is better, current dividends or growth? We saw in the preceding section that a firm can pay a higher current dividend by increasing its payout ratio, but that will lower its dividend growth rate. So the firm can provide a relatively high current dividend or a high growth rate, but not both. This being the case, which would stockholder prepare? The answer is not clear. As we will see in chapter 14, some stockholder prepare current dividend while others prepare a lower payout ratio and future growth. Empira, empirica, Empirical studies have been unable to determine which strategy is optimal for maximizing a firm stock price. So dividend policy is an issue that management must decide on the basis of its judgment. That a mathematical formula logical, shareholders should prepare for company to retain more earnings, hence pay less current dividends if the firm has exceptionally good investment opportunities. However, shareholders should prepare a high payout if investment opportunity are poor. In spite of this, taxes and other factors complicate the situation.
Valuing non-constant growth stocks. For many companies, it is not appropriate to assume that dividends will grow at a constant rate. Indeed, most firms go through life cycles where they experience different growth rates during different parts of the cycle. In their early years, most firms grow much faster than the economy as a whole. Then they match the economy's growth, and finally they grow at a slower rate than the economy. Then automobile manufacturers in the 1920s, computer software firms such as Microsoft in the 1990s, and Google in the 2000s are examples of firms in the early part of their cycle. These firms are defined as supernormal or non-constant growth firms. Figure 9.3 illustrates non-constant growth and compares it with normal growth, zero growth, and negative growth. In the figure, the dividends of the supernormal growth firm are expected to grow at a 30% rate for 3 years, after which the growth rate is expected to fall to 4%. The assumed average for the economy, the value of this firm's stock, like any other asset, is the present value of its expected future dividends as determined by equation 9.1. When DIT is growing at a constant rate, we can simplify equation 9.1 to equation 9.2. P hat 0 D1 RSG. In the supernormal case, however, the expected growth rate is not a constant. In our example, there are two distinctly different rates because equation 9.2 requires a constant growth rate. We obviously cannot use it to value stocks that are not growing at a constant rate. However, assuming that a company currently enjoying supernormal growth will eventually slow down and become a constant growth stock, we can combine equations 9.1 and 9.2 to construct a new formula equation 9.6 for valuing the stock. First, we assume that the dividend will grow at a non-constant rate, generally a relatively high rate, for n periods, after which it will grow at a constant rate. Gn is often called the horizon or terminal date. Second, we can use the constant growth formula equation 9.2 to determine what the stock's horizon or continuing value will be n periods from today.
Evaluating stocks and don't pay dividends. The discounted dividend model assumes that the firm is currently paying a dividend. However, many firms, even highly profitable ones, including Google and Dell, have never paid a dividend. If a firm is expected begin paying dividends in the future, we can modify the equations presented in the chapter and use them to determine the value in the stock. A new business often accept to have low sales during its first few years of operating, develops its product. Then, if the product catches on, sales will grow rapidly for several years. Sales growth being with it the need for additional assets as firm cannot increase sales without the increasing its assets. And asset growth requirement requires an increase in liability and or equity accounts. Small firms can generally obtain some banks credit, but they must maintain a reasonable balance between debt and equity. Thus, additional bank borrowing require increases in equity, and getting the equity capital needed to support growth can be difficult for small firms. They have limited access to the capital markets, and even when they can sell common stocks, their owners are reluctant to do so for fear of losing voting control. Therefore, the best source of equity for most small businesses is retaining earnings. For this reason, most small firms pay no dividends during their rapid growth. Eventually, those successful for this reason, most small firms do pay dividends, and those dividends generally grow rapidly as firm but slow down to a sustainable constant rate once the firm reaches maturity. If a firm currently pay no dividends but is expected to pay future dividends, the value of its stock can be found as follows. Number one, estimate at what point dividends will be paid. The amount of the first dividend, the growth rate during the supernormal growth period, the length of the supernormal period, the long run or constant growth rate, and the rate of return required by investors. Number two, use the constant growth model to determine the stock price after the firm reaches a stable growth situation. Number three, set out on a timeline the cash flows, dividend during the supernormal growth period of the stock price once the constant growth state is reached. Then find the present value of these cash flows. That present value represents the value of the stock today. To illustrate the process, consider the situation of for Marvel Lure Incorporated, a company that was set up in 2015 to produce a market a new high-tech fishing lure. Marvel Lure's sales are currently growing at a rate of 200% per year. The company expects to experience a high but declining rate of growth in sales and earning during the 10 years, after which analysts estimate that it will grow at a steady 10% per year. The firm management has announced that it will pay no dividends for 5 years, but that if earnings materialize as forecasted, it will pay a dividend of $0.20 per share at the end of year 6, $0.30 in year 7, $0.40 in year 8, $0.45 in year 9, and $0.50 in year 10. Next, the enterprise-based approach to valuation. Thus far, we have discussed the discounted dividend for valuing a firm's common stock. This procedure is widely used, but it is based on the assumption that the analyst can forecast future dividends reasonably well. This is often true for mature companies that have a history of steadily growing dividends. However, dividends are dependent on earning, so a reliable dividend forecast must be based on an underlying forecast of the firm's future sales, cost, and capital requirements. This recognition has led to an alternative stock valuation approach, the corporate valuation model. Rather than starting with a forecast of dividends, the corporate valuation model focuses on the firm's future free cash flows. We discussed free cash flows or FCF in chapter 3, where we developed the following equation. EBIT is earning before interest and taxes, and free cash flow represents the cash generated from current operations less than the cash must be spent on investment in fixed asset and working capital for support future growth. Consider the case of Home Depot or HD. The first term is brackets in the preceding equation represents the amount of cash that HD is generating from its existing stores. The second term represents the amount of cash the company plans to spend this period to construct new stores. To open a new stores, HED must spend cash to purchase the land and construct the building. These are the capital expenditures, and they lead to a corresponding increase in the firm's mixed assets as shown on the balance sheet. But HED also need to increase its working capital, especially in inventory. Putting in everything together, HED generates positive free cash flow for its investors if and only if if the money from its existing stores exceeds the money required to build and equip its new stores.
The corporate valuation model. In chapter 3, we explain the discussant explained that a firm's value is determined by its ability to generate cash flow both now and in the future. Therefore, its market value can be expressed as follows. A formula is presented. Market value of company equals value of company equals present value of expected future free cash flows. Here, FCFT is the free cash flow in year T, and the discount rate, the WACC, is the weighted average cost of all the firm's capital. When thinking about the WACC, note these 2 points. Number one is the firm finances with debt, preferred stock, and common equity. The WACC, or the weighted average cost, is the weighted average of the three types of capital, and we discussed it. The discussant discussed it in chapter 10. Free cash flow is the cash generated before any payments are made to any investors. It must be used to compensate common stockholders, preferred stockholders, and bondholders. Moreover, each type of investors has a required rate of return, and the weighted average of those returns is the weighted average cost, which is used to discount the free cash flows. Free cash flows are generally forecasted for 5 to 10 years, after which it is assumed that the final explicitly forecasted FCF will grow at some long-run constant rate. Once the company reaches its horizon date, when cash flows begins to grow at a constant rate, we can use the following formula to calculate the market value of the company as of that date. Horizon value equals the value of company at t, or the time, equals n, equals FCF n plus 1 equals a over weighted average cost minus GFCF. The corporate model is applied internally by the firm's financial staff and by outside security analysts. For illustrative purposes, we discuss allied free cash flow valuation analysis conducted by Susan Verstier, senior food analyst for the investment banking firm Morton Stanley and Company. Her analysis is summarized in Table 9.2, which reproduced from the chapter Excel model. Comparing the corporate valuation and discounted dividend models. Analysts use both the discounted dividend model and the corporate valuation model when valuing mature dividend-paying firms, and they generally use the corporate model when valuing divisions and firms that do not pay dividends. In principle, we should find the same intrinsic value using either model, but differences are often observed. When a conflict exists, the assumptions embedded, although the dividend growth and the corporate valuation models presented in this chapter are the most widely used methods for valuing common stocks, they are by no means the only approaches. Analysts often use a number of different techniques to value stocks. Two of these alternative approaches are described here. First approach to valuing common stock is the PE multiple approach. Investors have long looked for simple rules of thumb to determine whether a stock is fairly valued. One such approach is to look at the stock's price to earnings ratio. Recall from Chapter 4 that a company's P ratios shows how much investors are willing to pay for each dollar of reported earnings. As a starting point, you might conclude that stocks with low PE ratios are undervalued because their price is low, given current earnings, whereas stocks with high PE ratios are overvalued. Second is the EVA approach. In recent years, analysts have looked for more rigorous alternatives to the discounted dividend model. More than a quarter of all stocks listed on the NYSE pay no dividends. This proportion is even higher on Nasdaq, although the discounted dividend model can still be used for these stocks. Evaluating stocks that don't pay dividends. This approach requires that analysts forecast when the stock will begin paying dividends, what the dividends will be once it is established, and what the future dividend growth will be. In many cases, these forecasts contain considerable errors.
Preferred stock. Preferred stock is a hybrid. It is similar to a bond in some respects and to common stock in others. This hybrid nature becomes apparent when we try to classify preferred stock in relation to bonds and common stock. Like bonds, preferred stock has a par value and a fixed dividend that must be paid before dividends can be paid on the common stock. However, the directors can omit or pass the preferred dividend without throwing the company into bankruptcy. So, although preferred stock calls for a fixed payment, like bonds, skipping the payments will not lead to bankruptcy.
As noted earlier, a preferred stock entitles its owner to regular, fixed dividend payments. If the payment lasts forever, the issue is a perpetuity whose value VP is found as follows. VP is the value of the preferred stock, DP is the preferred dividend, and the RP is the required rate of return on the preferred. Allied Food has no preferred outstanding, but discussions about such an issue suggested that its preferred should pay a dividend of $10 per year. If its required return was 10.3%, the preferred value would be $97.09 found as follows. In equilibrium, the expected return must be equal to the required return RP. Thus, if we know the preferred's current price and dividend, we can solve for the expected rate of the return as follows. Some preferreds that have stated maturity open 50 years assume that our illustrative preferred matured in 50 years, paid a $10 annual dividend, and had a required return of 8%. We could then find its price as follows. Enter and 50 I rose to 10%. You would change. Allied Food has no preferred outstanding, but discussions about such an issue suggested that its preferred should pay a dividend of $10 per year. If its required return was 10.3%, the preferred value of would be $97.9 found as follows. In equilibrium, the expected return RP must be equal to the required return RP. Thus, if we know the preferred current price and dividend, we can solve for the expected rate of return as follows.
Stocks and their valuation, covering features of common stock, determining common stock values, efficient markets, and preferred stocks. Facts about common stock represent ownership. Ownership implies control. Stockholders elect directors. Directors elect management. Management's goal: minimize the stock price. Types of stock market transaction: secondary market, primary market, and initial public offering market or going public. Different approaches for valuing common stock: dividend growth model, corporate value model, using the multiples of comparable firms. Words to remember, things to remember in stock valuation. Market price, the price at which a stock sells in the market. Growth rate, the expected rate of growth, and then dividends per share. Required rate of return, the minimum rate of return on a common stock that a stockholder consider acceptable. Expected rate of return, the rate of return on a common stock that a stockholder expect to receive in the future. And actual rate of return, actual realized, the rate of return on a common stock actually received by stockholders in some past period. In terms are used in our analysis. DT, the dividend stockholder expect to receive at the end of each year. T is equivalent to year. D0 is the last dividend the company paid. Because it has already been paid, a buyer of a stock will not receive D0. The first dividend, a new buyer will receive D1, which is the year 1, which is paid at the end of the year 1. D2 is dividend expected in the end of the year 2, and so on and so forth. P0, actual market price of stock today. P0 is known with certainty, but predicted future prices are subject to uncertainty. P hat T, both the expected price and the expected intrinsic value of stock at the end of each year. T, pronounced as P hat T, as seen by investor doing the analysis. P hat T is based on investors' estimates of dividend stream and riskiness of the stream. There are many investors in the market, so there can be many estimates for P hat T. However, for the magical investor, P0 must equal to P hat T. Otherwise, this equilibrium will exist. In buying and selling in the market would soon result in P0 equaling P hat 0 as seen by the marginal investor. G is equal to expected growth rate. G in dividend as predicted by an investor. If dividends are expected to grow at a constant rate, G should also equal the expected growth rate in earnings and the stock's price. Different investors use different G's to evaluate a firm's stock, but the market price P0 is based on G as estimated by the marginal investor. KS or RS is equal to required or minimum acceptable rate of return on the stock considering its riskiness and the return available on other investments. Different investors typically have different opinions, but the key is again the magical investors. K hat S or R hat S expected rate of the return pronounced are K hat S or R hat S that an investor believes the stock will provide in the future. The expected return can be above or below the required return, but a rational investor will buy the stock if R hat 0 or K hat R hat S or K hat S exceeds RS. Sell the stock if R hat S is less than RS, and simply hold the stock if these returns are equal. Again, the key is the marginal investors whose view determine the actual stock price. K bar S or R bar S equals actual or realized after the fact rate of return. Pronounced are K bar S or R bar S. You can expect to obtain a return of RSK or KS 10% if you buy a stock today. But if the market declines, you may earn an actual realized return that is much lower, perhaps even negative. D1 or P1 is equal to dividend yield expected during the coming year. If the company's stocks excess stock is expected to pay a dividend of P1 $1 during the next 12 months, and if excess current price is P0 $20, the expected dividend yield will be $1 $20 0.05%. Different investor could have different expectation for D1, but again, the marginal investor is P hat 1 minus P0 or P0 is equal to expected capital gains yield on the stock during the coming year. If the stock sells for $20 today, and if it is expected to rise to $21 by the end of the year, the expected capital gain will be P hat 1 P0 $21 00 $20 and $1 and the expected capital gain yield will be $1 $20 0.05 and 5%. Different investor can have different expectation for P hat 1, but the marginal investor is key. Expected total return or R hat S, expected dividend yield D1 P0 plus expected capital gains yield P hat 1 P0 P0. In our example, the expected total return is 5%, and dividend growth model. Value of stock is the present value of the future dividends expected to be generated. Hat meaning expected value, P equals price today. Stock price today is P hat 0 equals to dividend of this coming year, D1, D2, D3, and so on. Constant growth stock, a stock whose dividends are expected to grow forever at the constant rate. If G is constant, the dividend growth formula converges to, so we cannot use the current formula because it's infinite, so we will use this formula. P hat 0 equals D0 plus 1 plus G is that is equals to D1, which is the present value is D1 over Ks minus G. Future dividends and their present value, the dividends is going up because every year nagdadagdag. Sa present value naman ay nagbababa because we are discounting the every year. The present value is going down or nagbababa because we are discounting the 1 plus K. What happens if G is greater than Ks? If G is greater than Ks, the constant growth formula leads to a negative stock price, which is that makes sense. So it could not happen. Then pwede mangyari ang G ay maging because G is the capital gain, which is the formula is Ks plus G. So it will never happen. The constant growth model can only be used if Ks is greater than G because G is expected to be the constant forever. Use the CAMP to calculate the required rate of return or Ks. So the example is if KRF is equal to 7% and Km is equal to 12% and D is equals to 1.2, what is the required rate of return on the firm's stock? Use the SML to calculate the required rate of return Ks. This is the Ks is equals to KRF plus Km minus KRF. Use use the SML to calculate the required rate of return or Ks. The formula is Ks equals KRF plus open parenthesis Km minus KRF close parenthesis B. So change, substitute that to 7 value, which is 7% plus open parenthesis 12% minus 7% close parenthesis 1.2. That will be equals to 13%. What is the stock's market value using the constant model growth? P0 equals D1 over Ks minus G equals to 2.12%. If D0 equals 2% and G is a constant 6%, find the expected dividend stream for the next 3 years and their PVS. So 2 times D0 equals 2 times D0 is equals to 2, so 2 times 1.06, which is the G is equals to 6%, is equals to 2.12. 2.12 times 1.06 is equals to 2.247. 2.247 times 1.06 is equals to 2.385. And we will be discounting them for 13%. So 2.12 divided by 1.13 is equals to 1.8761. 2.247 divided by 1.13 is equals to 1.7599. 2.382 divided by 1.13 is equals to 1.6509, meaning that dividend is growing while the present value is shrinking. This is the dividend and the present value. And this explains why G cannot be greater than Km. What is the stock's market value using the constant growth model? So D1 in the previous problem, D1 is equals to $12 and KS is 0.13% and G is 6%. So decimal that is 0.06. So $2.12 divided by 0 equals to 30.29%, and that is the expected value for the first year. Or the what is the expected market price of this stock 1 year from now? So D1 will have been paid out already. So D1 is the present value as of year 1 of D2, D3, D4, etc. D1 equals D2, same formula, just different dividends or year. So the second year is the dividend 2. D2 is equals to 2.247 over 0.13 minus 0.06 equals to $32.10. Could also find expected P as P1 equals P0, 1.06 is equals to $32.10. It is the expected dividend yield, capital gain yield, and total return during the first year. Dividend yield is D1 or P0 is equals to 2.12, and the P0 or price stock is $30.29, is equals to 7%, and capital gain yield is P1 minus P0 or P0s, $32.10 minus $30.29 or 30.29 is equals to 6%. Total return or KS, dividend yield plus capital gains yield is 7% plus 6% is equal. What will the expected price today be if G is equals to 0? The dividend stream will be the per GT. Just change the D1 or dividend into payment PMT over K, which is the 30%. So $2 over 13 is 0.13 or is equal to $15.38. Supernormal growth. What if G equals 30% for 3 years before achieving long run growth of 6%? Can no longer use just constant growth model to find stock value. However, the growth does become constant after 3 years. So, valuing common stock with constant growth. So, D1 to D0 to D1, G growth is 30%, but the KS is still 13%. So every year in 3 years, the growth is 30%, which is 2 times 1.30 is equals to 2.600. 2.600 times 1.30 is equals to 3.380. 3.380 times 1.30 is equals to 4.394. That will be the growth in dividends for the past 3 years. But in the fourth year, it will be 4.394 times 1.06, that will be equal to 4.658. So 658 over 0.13 minus 0.06 is equals to 66.54%, and the present value will be add up to be a p hat 0, which is the expected present value is present expected present stock price would be 54.107. Find expected dividend and capital gains yield during the first and fourth year. Dividend yield first year is $2 point sa price is 2.60. The sa dividend is 2.60, sa price is sa dividend yield first year $2, 2.60, and 54.11 was to 4.81%. Capital gain yield first year is 13% minus 4.81% was 8.19%. During the non-constant growth, dividend yield and capital gains yield are not constant, and capital gains yield is equal to G. After T equals 3, the stock has constant growth and dividend yield 7%, while the capital gain yield is 6%. So non-constant growth, what if G equals 0% for 3 years before long run growth is 6%? So wala silang i-divide. So hanggang sa 3 years ay 0%. So permit 2, palaging 2, which is in the fourth year is 2.02 times 1.06 is equals to 2.12. So 2.12 is equals to P hat 3. P hat 3 equals 2.12 over 0.13 minus 0.6 equals to 30.829. Pero kahit same pa rin ang dividends ang year, ang present price stock value, ang P1 ay ang price ay nagbababa. So ang expected price ay 25.72 cents. Expected dividend and capital gains yield during the first and fourth year. So 7.78%, 5.22%, still the same growth, and dividend yield is 7%, while the capital gains yield is 6%. If the stock was expected to have negative growth, G was minus 6. G is equals to negative 6%. Would anyone buy stock here? The firm still has earnings based dividend even though they declining based on. So the formula will still be the same. So G1 over KS minus G is equals to. So substitute ito sa 2 times 0.94 over 0.13 minus negative 0.06 is equals to $1.88 over 0.19 equals to 9.89. Find the expected annual dividend and capital gain yield. So, capital gain yield is G equals negative 6%. Dividend yield is equals to 13% minus negative 6% is equals to 19%. Since the stock is experiencing constant growth, dividend yield, capital gains yield are constant. Dividend yield is sufficiently large by 19% to offset